the past, most investors used actively managed funds. In other words, they paid fund managers to try to outperform the market by picking which stocks to buy and sell at the right time. It seems a sensible strategy in theory, but there's overwhelming evidence that in practice, traditional active management simply doesn't work. Wes Crill is Senior Investment Director at Dimensional Fund Advisors.
The idea behind traditional active methods of investing can sound appealing because every year you're going to have some managers who have greatly outpaced the overall market, likely through traditional means or concentrated positions. And those are the ones that are going to garner attention. The broader array of performance in traditional active management might take a back seat to those kind of success stories. And I think for many investors, that can have a lot of appeal if they haven't really taken time to dig into the data to see how that could just be luck and not skill.
What then does the evidence tell us about active fund performance? Well, there have been numerous studies since the 1960s showing that on a properly cost and risk adjusted basis, the vast majority of active funds fail to outperform their benchmarks in the long run. In fact, the proportion of active funds that do outperform has decreased over time.
Yeah, this is an area where there's been research for 6 decades now dedicated to assessing the performance of traditional active managers. And the percentage of them that are able to outperform is very small. A lot of investors would be surprised. I think one of the gold standard academic papers on this is from Fama and French years ago, where they looked at luck versus skill, as they call it, in the cross-section of mutual funds. And when they looked at the distribution of outcomes from these managers, and clearly you're going to have in any given year very strong performers, you're going to have very strong underperformers, and they attempted to control for the style of all of these different strategies, and then looked at the distribution of what you would expect if it were nothing but a coin flipping exercise. And remarkably, the distribution of actual results was very similar to what it would look like if no one had any skill whatsoever. So I think that's a very important concept because the ones you're going to read about are going to be the strong performers or maybe the strong underperformers. What the data tells us is that those track records really don't tell you anything about their skill going forward.
None of this is a reflection on the application or intelligence of fund managers. Most are very smart and work very hard. But the odds of success are heavily stacked against them.
If you look at many industries, most industries in fact, the people who went to school the longest, who were the brightest, who worked the hardest, are likely to produce better outcomes. It's true in medicine, it's true with dentists, it's true with professional athletes. But investing, because the industry is so competitive, because there is so much activity when it comes to pricing stocks and bonds, that all of that rigor you might go through isn't going to give you an edge when it comes to outperforming the broad market. And I think that's counterintuitive for a lot of investors, and certainly that's a lesson that all of us should learn at some point, and that's what all of the research is dedicated to portraying.
Why then do so few active managers outperform? Well, in simple terms, markets are highly efficient. In other words, they fully reflect all available information. New information is priced into assets within seconds, making it virtually impossible to identify stocks that are either underpriced or overpriced with any consistency.
Once you control for different style elements of an investment strategy, it comes down to, for an active manager, whether they can get an edge on the rest of the market. And that means they have to know something the rest of the market doesn't know. They either need to know information that's relevant to expected future cash flows for companies that's not yet been stumbled upon by the rest of the market, or you have millions of people looking for this every second of every day, so that strains credulity. You'd be able to do that on a regular basis. Or you got to be faster. You got to be able to act on something that you believe the rest of the market has not yet acted on. And it's a zero-sum game at the end of the day, because for you to be able to get ahead of the market, that means you have to do it at the expense of another active manager. So when you have thousands of professional managers, millions of market participants who are looking for these kind of things, trading based on their expectations for the future, that's an incredible stream to be swimming against. And I think that explains to a large extent the paucity of active managers that have been able to outperform.
So what does all this mean for investors? As we've already seen, very few active funds genuinely outperform their benchmarks in the long run. Those that do are also very hard to identify in advance. So your chances of picking an active fund today that will still be around in 25 or 30 years' time and will have outperformed are very slim.
From a French study on mutual fund performance, they found that only about 3% of the equity managers they studied were able to at least cover their costs. So what that means is the excess return they were able to provide over a benchmark was almost exactly offset by the fees and expenses the investors paid. So net of the fees, there's not what we would call alpha there. And that's a very long shot for investors. Some of the other studies that we've looked at, so over the past 20 years, only about 18% of actively managed mutual funds have been able to outperform their prospectus benchmarks. And even more insidious beyond that, only about 45% of them have actually survived the full 20 years. So I think it just shows what the odds are facing investors if you pursue an investment experience that is about trying to time markets or outguess markets.
In short, stock markets are really difficult to beat over meaningful periods of time. Trying to pick an active fund that will outperform in the future is usually a waste of time and effort. Thank you to Wes Crill from Dimensional Fund Advisors and to you for watching.